Hello, everybody. In Chapter 19, we're going to be talking about using securities markets for financing and investing opportunities. So, in this chapter, we're going to be talking about the function of securities markets, stock exchanges, how businesses raise capital by selling stock, how businesses raise capital by issuing bonds, how investors buy securities, investing in stocks, investing in bonds, investing in mutual funds and exchange traded funds, and then understanding the stock market indicators. So, somebody who you might be familiar with when it comes to stocks is Jim Cramer. So he's on CNBC. He has his own show called Mad Money. So Jim Cramer, he earned a bachelor's and he was a magna cum laude from Harvard. He went to Harvard Law School after that and then began trading stocks. So he became a stockbroker at Goldman Sachs before starting his own hedge fund. And then, due to the pressures of the business, he retired, wrote 3 books, and began Mad Money. The objective is to educate investors about stocks and dividends. So that is one of the things about getting into kind of like the stock game, working for a big bank such as Goldman Sachs. It's very competitive. It can be a lot of pressure. So you do see a lot of people getting out of it, even though when you are in it, you can learn or can earn a lot of money with it. Some of the functions of security markets. So, security markets are financial marketplaces for stocks and bonds and serve 2 primary functions. So, assist businesses in finding long term funding to finance capital needs, and then also provide investors a place to buy and sell securities such as stocks and bonds. So some of the types of securities markets. So you have primary markets. These handle the sale of new securities, and then secondary markets handle the trading of securities between investors, with the proceeds of the sale going to the seller. Then with that we have the initial public offering or IPO. This is the first public offering of a corporation stock. So more recently we've heard about Uber. They had an IPO. Lyft also had an IPO. Some of these tech companies are coming out. Facebook had an IPO. I think it was probably about 5 years ago or so. So this is going to be that first moment when a company is available to the public, and the public can buy stock into that company. So the enroll investment bankers. So investment bankers, these are the specialists who assist in the issue in the sale of new securities. And then you have institutional investors. These are large organizations such as pension funds or mutual funds that invest their own funds or funds of others. For a mutual fund, we talked about Jim Cramer. He started his own mutual fund. What they're doing, they're getting a group of investors together to invest into the fund, and then the people working for the mutual fund will take those funds and invest them in stocks and bonds, and hopefully get a good return out of that. So mutual funds are a very big thing on Wall Street. You've got the stock exchange, which is an organization whose members can buy and sell securities for companies and investors. Think New York Stock Exchange, and then we've got over-the-counter market. This is the exchange that provides a means to trade stocks not listed on the national exchanges. And then we also have Nasdaq, which is a nationwide electronic system that communicates over the counter trades for brokers. So the New York Stock Exchange was once the largest floor-based exchange in the world. Today, stocks are bought and sold primarily on electronic networks. The right photo of the exchange floor today seems deserted compared to the old days. So, on the left-hand side, it looks like, that was probably about from the 1980s, which was a very big time, for, stocks in America. And then over on the right-hand side, that's kind of a snapshot of what it looks like today. The New York Stock Exchange, that picture on the right, it's mainly just kind of a place where people go for, photo ops and that sort of thing. There's not a whole lot of business being done on the floors anymore, just because it's all being done, through the internet. So some of the top stock exchanges around the world. So we've got the New York Stock Exchange, Nasdaq, London Stock Exchange, Tokyo Stock Exchange, and then the Shanghai Stock Exchange as well. So we do live in a very big world, so just don't think about, the stocks and bonds that are being traded here in the United States. They're being traded everywhere throughout the world. So, you can go over to England, trade in London, Japan, Tokyo, and then China. You can have, the Shanghai Stock Exchange as well. So security regulations and the Securities and Exchange Commission. So the Securities and Exchange Commission, the SEC. So this is the federal agency that has responsibility for regulating the various exchanges. It was created in 1934 through the Securities and Exchange Act. So if you think about a movie like Wall Street or Wolf of Wall Street. Uh, these are going to be, I guess the bad guys in those movies that are always, coming down, on the stockbrokers. So the SEC, more than times than not, that's what they're referred to as, and that's what you'll hear about, in different movies and different TV shows. So most of you have probably seen some sort of TV show where the SEC, comes into play. So prospectus, this is a condensed version of economic and financial information that a company must file with the SEC before issuing stock. So the prospectus must be sent to prospective investors. So this is essentially just saying if you are coming out you with an IPO at some point, this is just kind of giving a lowdown of, here's what we kind of expect out of our company. Here's what we've been doing as far as like, the funds that we've raised, and just making sure that you have a good, strong company. Because, if you don't have a good, strong company and people invest in it, then they're going to lose a lot of money, and then that's going to raise, a lot of red flags with the SEC. So foreign stock exchanges, investors can buy securities from companies almost anywhere in the world. So foreign investors can also invest in U.S. securities. So you can have somebody over in Europe who's investing in U.S. securities. You can have somebody in the U.S. who's investing, in European securities. Like I said, the world's a very big place. There's a lot of money to be made. So, especially some of the big, stockbrokers, such as like a Goldman Sachs, they're invested all around the world in a very big part in all the stock exchanges. So the stocks, these are just the shares of ownership in a company. So if you buy one stock of Walmart, then you own a piece of Walmart. Stock certificate. This is evidence of a stock ownership that specifies the name of the company, the number of its shares, and represents the type of stock being issued. It used to be in the olden days that was an actual piece of paper that stockholders would get. They no longer do that just because of electronics. So if somebody does have like really old stock that they've just never sold or something like that, in a bank safety deposit box, they might end up having some of those old stocks. Dividends, these are just part of the firm's profits that a firm may distribute to stockholders as either cash payments or additional shares of stock. So if a corporation such as like Caterpillar has a really good year, they will pay dividends to their stockholders. So, just as I say there, it might be cash. They might get, $500, per share, or it could just be additional shares of stock. So they could just, kind of, give them additional stock on it. Advantages of issuing the stock. So stockholders or owners of a firm and never have to be repaid their investment. There's no legal obligation to pay dividends. And then issuing stock can improve a firm's balance sheet since stock creates no debt. Some of the disadvantages of issuing stock. Stockholders have the right to vote for a company's board of directors. Issuing new shares of stock can thus alter the control of the firm. So if you do have, one person around who has a lot of stock into a company, if you're issuing more stock, they can buy more, stock into that company, and then they can kind of pretty much control the organization. Dividends are paid from after-tax profits and are not tax deductible. And then the need to keep stockholders happy can affect managers' decisions. So a lot of time that's what you'll hear like in press conferences is a company made a decision just because of pressure from the stockholders or want to have a good dividend, good return for the stockholders. So if they're constantly issuing stock and you're not getting any money back, at some point you're probably going to hear it from your stockholders and say, I invested in your company, I'd like to see a rate on that return instead of just giving me more stock in that. I mean, at the end of the day, if you're not getting any money off of a company you're investing in, kind of what's the point? So issuing shares of common stock. So common stock is the most basic form of ownership in a firm. It confers voting rights and the right to share in the firm's profits through dividends. So anybody who has stock into a publicly traded company, they can go into any owners meetings and they have a voice into that company just because they do own that company or part of it. issuing shares of preferred stock. So preferred stock is going to be a stock that gives its owners preference in the payment of dividends and an earlier claim on assets than a common stockholder. So preferred stock can also be uh, callable, convertible, and then a cumulative. So with preferred stock, a lot of times what you'll see is, like senior management will get a lot of preferred stock, or individuals who are on like the board of directors. Those individuals will also get preferred stock. So when Fitbit issued its initial public offering, the company raised nearly $740 million from the sale. Can you see why issuing stock can be an appealing option for financing a company's growth? So we'll use Fitbit for this example. They probably had capital venturists who were investing in the company very early on, but at some point you can only get so much money from venture capitalists. So they probably capped them at, say $100,000 for, or not $100,000, $100 million, for example. And then at that point, Fitbit is wanting to grow, and the only way they can do it is they can go with the IPO. Then at that point, they open it up to pretty much anybody in the public, and then the people in the public can buy into that company, and then that helps the corporation grow bigger. They can start investing in new technologies, start investing in new real estate, different things like that. It's also a great way for a lot of these owners of the company to get repaid for the contributions that they've made. So for example, like Mark Zuckerberg and Facebook, all the time and money that he put into Facebook itself, and then anybody else who had kind of a stake in Facebook, some point, I mean, yeah, you are getting returns on it, but the real money is when you start issuing stock on that. So once they issued stock on it, he went from being, having a couple $1 billion to having multiple $1 billion. So, and that's just something that happens overnight. So learning the language of bonds. So a bond is a corporate certificate indicating that a person has lent money to a firm. The principal is the face value of the bond. Maturity date, the exact date the issuer of a bond must pay the principal to the bondholder. So it might be 20 to 30 years down the line, might be a shorter amount of time. And then the interest, so this is the payment the issuer makes to the bondholders for the use of borrowed money. So same kind of thing as, like if you have a car loan at a bank, just how you're getting charged interest, you're also getting charged, on those bonds. So types of government securities that compete with corporate bonds. So you have a U.S. government bond, so issued by the federal government. These are considered the safest type of bond investment. So this is just investing, into your government. And then at some point, usually U.S. bonds are 30-year term. After 30 years, you can transfer that bond into actual cash. You have a treasury bill or a T-bill that matures in less than a year, issued with a minimum denomination of $1,000. Treasury note matures in 10 years or less, sold in denominations of $1,000 or $1,000,000. You've got a treasury bond, which matures in 25 years or more, sold in denominations of $1,000 or up to $1,000,000. A municipal bond issued by states and cities and counties and other state and local government agencies, usually exempt from federal taxes. And then you've got a Yankee bond, which is issued by a foreign government, payable in U.S. dollars. So, municipal bond, that is the example that I've, used most of the time whenever somebody is, or a city or state, it has a very big project coming up, such as a like a stadium. Advantages of issuing bonds. So bondholders are creditors, not owners of the firm, and cannot vote on corporate matters. So essentially, you just kind of have to pay them back at some point. It doesn't matter kind of what their views are on your company. They have no say in it. Bond interest is tax deductible, so anything that accrues in that, you can write off in your taxes. Bonds are a temporary source of funding that are eventually repaid. And then bonds can be repaid before the maturity date if they are callable. Disadvantages of issuing bonds. So bonds increase debt and can affect the market's perception of the firm. So paying interest on bonds is a legal obligation. If interest is not paid, bondholders can take legal action. And then the face value of the bond must be repaid on the maturity date. So, bondholders have a lot of the same rights as, say, like a bank would have, to where, if they're not getting paid, they can take that legal action. They can take you to court and recoup, as much of the funds as possible. So here are the bond ratings. Up at the top you've got the A's, and then down to B's, and then C's, and then even like the D under the Fitch ratings. So Illinois right now, we are in the B's, which is medium grade to lower medium grade, meaning if you buy a state bond from Illinois, you might get paid back, you might not get paid back. It wasn't that long ago. I'm going to say within the last year or two, we were the lowest grade possible. We were in that C and D range for it. So we have made a little bit of a comeback, but we're still not the highest quality of bonds possible. So we have different classes of bonds. So unsecured bonds, these are not backed by specific collateral, just like we talked about in last chapter, where you have unsecured and secured loans. Same thing apply to bonds. And then you've got secured bonds are backed by collateral such as land or equipment. So special bond features. So if you got sinking fund, this is the reserve account in which the issuer periodically retires some part of the bond principal prior to maturity so that enough capital will be accumulated by the maturity date. Callable bonds permit bond users to pay off the principal before the maturity date, and then convertible bonds allow bondholders to convert their bonds into shares of common stock. So a stockbroker, this is a registered representative who works as a market intermediary to buy and sell securities for clients, investing through online brokers. So online trading services such as TD Ameritrade, E-Trade, and Fidelity offer securities trading services online to buy and sell stocks and bonds. Online brokers can charge much lower trading fees. So, online trading services such as the TD Ameritrade, E-Trade, anybody can sign up for it. Some of those websites do have a minimum amount that you have to put into the account with it, whether it's like $1,000 or $500, something like that. But then at that point, you can trade as many stocks as you want to. Invest in any sort of bonds. The only issue with that is they are going to take, some sort of cut for making those trades for you, and that's just, part of their pay structure. Online brokers can charge, much lower trading fees. The second bullet point there, than if you actually had somebody who, you were working with. Such as like a financial planner or something like that, they might charge a little bit higher fees just because they kind of know exactly what they're doing. You're paying for their service and their expertise in it, whereas online brokers and online trading services, it's kind of on you, which is a little bit of higher risk, but you can save money that way. So if being a stockbroker is something that you're wanting to do, might be a good idea to kind of go out, maybe get an account through E-Trade or Fidelity, and try to practice a little bit, on your own. See if you can make a few bucks on it that way. So in choosing the right investment strategy, so consider 5 criteria when selecting investment options. So you've got the investment risk. So kind of what are you investing in? What kind of yields are you looking to get out of it? Duration, is this going to be a short-term thing or a long-term? Liquidity, if you go ahead and cash out of your stocks or bonds, how easy is that going to be? Are you going to be able to recoup all of your funds? And then tax consequences is how much are you going to get taxed on all this? So investing 101, so some things to do before making your first investment. So in Take Investing class, so I probably wouldn't recommend taking or getting into stocks and bonds right after this class. This is just very basic kind of business 101 course. I would work or take a financial management course. They're going to go into more ratios and more things to look at whenever you're looking at stocks and bonds. So I would definitely do that. Attend a conference. You can go into, there's multiple conferences, especially in bigger cities such as like a Chicago or St. Louis. Well, you'll probably have, a stockbroker from New York who will come in, do a quick conference for a small fee, and then you can learn some kind of new techniques from them. Head to the library or bookstore, pick up an investing book. You can learn a lot from that. Consult with experts. Reach out to a financial planner. If they're able to kind of like guide you along without charging a fee, that can be a great way as well. Have a diversification plan, so don't just invest in just one stock. Make sure you spread it around. Invest in different industries. Invest in stocks and bonds. Make sure that you're investing in higher risk and lower risk. Don't do it all on high risk. Look at stock histories. Typically has this been a very good, company over the years? I probably, would invest in like a Facebook right now just because there isn't that much history with that company, especially because tech companies can be very volatile. But if you're looking at, a company such as like a Caterpillar or something that's been around for a very long time, or like a General Electric, those are usually very safe companies to invest in. So average annual return of assets classes. So this is since 1926. So you've got small company stocks at 12%, large company stocks at 10%, corporate bonds about 6%, long-term government bonds at 5.6%, and then treasury bills of 3.4%. So overall, these are pretty good returns to get on your investment. So if you were to, just put your money, in a bank or in like a credit union in an account, you could get it like a certificate. That is paying anywhere between say 3 and 5%, something like that. But if you can make more than 3 or 5%, you probably want to go down that road. I mean, just putting money into like a small company or a large company, you're going to average 10 to 12% on that. And there is risk associated with that, just because we could have another recession, we could have a depression. I mean, we don't know, but at the same time, anytime we do have a recession or depression, we always bounce back. So that's kind of the give and take with stocks is, even if you invest in it, kind of expect to maybe lose a little bit of it, but it's always going to come back around, just because companies are constantly growing, and that's why it's really important to invest in the right company, especially if it's going to be a long term kind of thing for you. If you're looking for the kind of those short term returns, I probably wouldn't advise the stock market for you, just because it is up and down a lot. And more of the short-term investing, those are kind of for those stockbrokers and those professionals. Where if you're just kind of doing it as a little bit of a hobby, I'd probably recommend just kind of looking at those kind of longer-term investments. Diversification, so buying several different investment alternatives to spread the risk of investing. So if diversifying investor may put 25% of his or her money into U.S. growth stocks, 25% in government bonds, 25% in dividend paying stocks, and then 10% in international mutual fund, the rest in a savings account. So, this is a really good example of how you can diversify. Uh, if any of you have like a 401k or anything, most of your 401ks are probably following kind of like the same kind of guidelines, to where they're, very diversified. A lot of, companies will even let you pick your own kind of 401k plan on how risky that you want to be. If you're a younger person that's just getting starting out with their career, you can choose a lot riskier stocks and bonds than if you were somebody who's like 60, 65, getting ready to retire. Then at that point, you want to be pretty low risk and making sure that you're getting solid returns every year. So I would say, if you're early on in your career, if you're looking to get pretty good returns, you're looking for those 15, 16% returns every year, you're going to be investing in some very risky stocks for it. Whereas later on in your career, you're just hoping to get 5 to 10% return on your investment. So primary investment services, consumers need savings and investing advice, help with their 401k plans, retirement planning, tax planning, estate planning, education expenses planning. So all of these are things that financial planner is going to be able to help you out with. An accountant is also going to be able to help you out with. Most bankers will also be able to help you out with. So reaching out to those individuals that have expertise in those fields can really help you in the long run, especially if it's something like tax planning, estate planning. Those can be difficult kind of subjects to understand. So best to get somebody who knows what they're doing on it. So perceptions of the market. So a bull's market, which is an investor who believes stock prices are going to rise, and then you have a bear's market, which investors who expect stocks price to decline. So bulls and bears. That's actually how the Chicago Bulls and the Chicago Bears got their names. Was due to the stocks. So selecting stocks so you can capital gains. This is the positive difference between purchase price and of a stock. And sale price. So investors who also choose stocks according to their strategy. So you got blue chip stocks. So these are the best stocks that you can kind of get. Growth stocks. Maybe like a Facebook might be a kind of a growth stock. You anticipate it to have a lot of growth over the next 5 to 10 years. Income stocks. these are the ones that are paying out dividends mostly every year, and then you've got your penny stocks, which might be something very early on. They just kind of did it like an IPO. It's maybe not as publicized as say like a Facebook or something like that. Maybe like their stock is only like 50 cents. You invest into that, and then hopefully has a high return, and then you can cash out for maybe like $5 per stock. So it's fun to stop and enjoy Dairy Queen Blizzard, especially if you own the company. So Warren Buffett built his fortune through prudent investing to become one of the wealthiest people in the United States. So Warren Buffett, most of you have probably heard, who he is. He runs Berkshire Hathaway, which is, a hedge fund, but it is a publicly traded company. He invests in a lot in U.S. companies and keeping things kind of local here in the United States. So he owns Dairy Queen, just bought Heinz a few years ago. So a lot of food companies, and I mean they're very diversified and they're kind of all over the place. Berkshire Hathaway, they're also into real estate, so you might see like a real estate agent who's with Berkshire Hathaway. One of the kind of the cool things about Warren Buffett, he has a son. Trying to think what his name is, but his son actually owns a lot of farm land here in Illinois, especially around like the Decatur area, and his head office is right in Decatur, so kind of a local presence there. So bear market declines in the S&P 500. So in 2007 to 2009, we saw a percentage drop in prices of just over 50%. So you can kind of look to see some of the 2007 to 2009 there was a recession, but then also some other troubling times in the United States where we saw some pretty drastic drops in the prices of stock. Currently, we are in a bull market, so everybody's kind of anticipating stocks to keep rising. We've been in a bull market since 2009, and I mean this has been going on for 10 years now, which is pretty much the highest it's ever been since after I think World War II. So we're doing pretty well, as an economy right now. It's getting to the point now where everybody's kind of being a little more pessimistic on it, and it's slowly going to start to turn into a bear market, and eventually, but just trying to figure out when that time has come is going to be the difficult part. So stock splits. This is an action by a company that gives stockholders 2 or more shares of a stock for each one that they own. Splits cause no change in the firm's ownership structure and no immediate change in the investment value, and then firms can never be forced to split their stocks. You got buying stock on margin. This is purchasing stocks by borrowing some of the purchase cost from the brokerage firm. Margin is the portion of the stock's purchase price that the investor must pay with their own money. So then if a broker issues a margin call, the investor has to come up with the money to cover the losses on that. So understanding stock quotations, we'll kind of go over one here in a second. So information that's on there is you've got your highest and lowest price for the day, high and low over the past 52 weeks, dividend paid, dividend yield ratios such as price earnings ratio, earnings per share, and then the number of shares traded. So here we've got the example here. So we've got previous close. This is what the stock price closed at yesterday. At the end of the day, here's kind of what it opened up at. So when it first came available today, it was at 71.90. Over here we've got the market cap. So this is Microsoft. So they're at 552 billion stocks issued. So this is going to be all the stocks that are out there currently being held by owners and investors. We talked about down here about the week range. So over the last year, the stock has gone from $55 all the way up to $74. So that's a really good thing to look at. You can also look at charts like over the year to see, throughout the year, when was the high point, when was the low point. You've got the price earnings ratio right here. This is, kind of a quick thing that you can kind of memorize with that. So if you invested, say, $31 in this example, that would be kind of how much you would expect to invest in order to get $1 back. So Companies with lower PE ratio probably aren't going to be as solidified as say like a Microsoft. So some of the companies who have a higher um, PE ratio, such as like a Microsoft or an Amazon or like a Walmart or something like that, they might be anywhere between 20, 30, 50, even higher than that. So just kind of depends on how much you're willing to invest and how much cash you're wanting to get back on it. So, a couple of things that you can take a look on here. If you're super interested in this, I would highly recommend taking some sort of financial management course, and they'll go into different ratios and different types of strategies that you can use with stocks. So the Nasdaq price wall. So if you stroll through Times Square in New York City, you will never have to wonder how stocks are performing on the Nasdaq exchange. The Nasdaq price wall continuously updates prices in the number of shares being traded, so you can always take a look there. If anybody has an iPhone, you can always go on your iPhone. There's a stocks app. There's tons of different apps and websites devoted to stocks and bonds that are currently out there as well. So top financial news and research sites. So Bloomberg, this was the company that was started by Michael Bloomberg. He was a former mayor of New York, multi-billionaire. Has thrown around the idea of running for president a few times. Forbes magazine. You've got MSN Money, The Street, Dow Jones and Company, and the Motley Fool. So for the most part, whenever I'm kind of researching, companies, I'll do most of it actually through Google. Yahoo, they used to have a really good finance section as well. Bloomberg, I do like them quite a bit just because they try to be as unbiased as possible when it comes to a lot of this stuff. So, Wall Street Journal, you can go out there. The kind of the issue with the Wall Street Journal is it is a paid subscription. So if you want to get a lot of good information from it, you do have to pay for it. So first-time bond investors generally ask two questions. So do I have to hold a bond until the maturity date? And then how can I assess the investment risk of a particular bond issue? So investing in high-risk junk bonds. So junk bonds are super high-risk, high-interest bonds. So Illinois was almost to a junk bond status a couple of years ago. So essentially, if somebody was buying bonds from the state of Illinois, super high risk, but at the same time, you could get a lot of money out of it, but you know, it's huge risk because you might not ever get paid back. Mutual fund, this is an organization that buys in stocks and bonds and then sells shares in those securities to the public. So the fund pools investors' money and buys stocks according to the fund's purpose. And then exchange traded funds or ETFs, these are the collections of stocks that are traded on exchanges but are traded more like individual stocks than mutual funds. So percentage of households owning mutual funds, as the years have gone up, more and more houses are buying into mutual funds. So that's definitely a good outlook for the Wall Street and stocks. So some of the comparing investments here. So, with bonds, you do have the lower risk bonds. Expected income is pretty secure, and then possible growth, you're not going to get a whole lot out of it. So, common stock, the degree of risk can be very high with that. Expected income, it can be variable on that, but then possible growth can also be very good with that. So, depending on how much risk that you're wanting to take in and how much growth that you want to get out of it, I mean, there's all sorts of different options for your investments. So Dow Jones Industrial Average, or just referred as the Dow. So this is the average cost of 30 selected industrial stocks used to give an indication of the direction of a stock market over time. Critics say the 30 company Dow is too small a sample and suggest following the S&P 500. The S&P 500 tracks the performance of 400 industrial, 40 financial, and then 40 public utility, and 20 transportation stocks. Usually I will look at this S&P 500. The Dow, just kind of as it says, it is a super small kind of sample size. So for the most part, I trust the S&P a little bit more. So some of the original Dow and current Dow companies. So the original Dow, you've got American Cotton Oil, Chicago Gas, General Electric, U.S. Leather, U.S. Rubber Company. Some old school kind of companies there. So the current Dow companies, American Express, Apple, Boeing, Caterpillar, Chevron, IBM, Johnson Johnson, 3M, Microsoft, Travelers, Verizon. So all of these are household names and really good companies to kind of look at. So one of the good things, even though it is such a small sample, is all of these companies are very well run companies that you can rely on on a daily basis and kind of figure out exactly how they are doing. So riding the market's roller coaster. So, October 29, 1929, this is Black Tuesday. The market lost 13% of its value. So this was kind of the start of the Great Depression at that point. October 19th, 1987, the market suffered its worst one-day drop when it's lost 22% of its value. So that day is, mentioned in Wolf of Wall Street. In October 27th, 1997, fears of an economic crisis in Asia caused widespread panic and losses. So the market collapsed into a deep decline in 2000 through 2002 when tech stocks bubble burst. Investors lost $7 trillion in market value. So whenever you hear about like a bubble, there was a housing bubble, there was a tech stock bubble. So essentially, kind of what that's saying is, like for this example, in 2000 to 2002, a lot of individuals and a lot of companies were investing into tech companies and tech stocks. And eventually, all these companies, even if they're a proven company with a good idea or not, they're getting investments into them. And then, they're getting bigger and bigger. So the bubble is getting bigger and all these companies are getting bigger. And then eventually, they find out that these companies didn't have a great idea or they didn't have a great business plan or whatever it might be. And, the company starts to decline, and then more and more of these companies start to go out of business, and then at that point, the bubble bursts. So anytime you hear about a bubble, that's kind of a thing to look out for and be kind of skeptical. One of the things that you might hear about a bubble right now is there might be another tech bubble. Student loans, that's another bubble where a lot of these or the United States are forgiving a lot of these student loans of a lot of students, and then they're being forgiven. So I mean that's coming back on the United States. So I mean it seems to be kind of a new bubble every couple of years that people are looking at. So starting in 2008, the financial crisis fueled a massive exodus from the stock market, resulting in record losses. So this was right in the middle of the Great Recession that we went through. So investing in the stock market has never been for the faint of heart. The market seems to have continuous steep climbs and sharp falls. Do you have the risk tolerance to survive the wild market swings? So, I would say, overall, the stock market is a very good investment to get into, but it is one of those things I would say it's more of a long-term thing than a short-term, just because you do have, those times where the stock market is going downhill and then you're going to lose money off of it. But if you just kind of ride out the storm, wait for it, it will bounce back. I got into college and I graduated high school in 2008, so I got into college at that point, and stocks were at an all-time low because of the recession. And all my business professors pretty much told me is, all the stocks that they had invested in, they were losing money on, but they were going to, stand there and wait for them to bounce back. And then, starting in 2009, we got into the bull market. Things started to look up. And then now, all their stocks did come back, and they've made quite a bit of money off of it just by riding it out. So, if you start to lose money on it, it's not the best idea to sell your stocks in those situations, just because you're going to lose that money in the long run whenever it bounces back. The Wall Street of now. So these are just kind of some differences between the Wall Street that you might see in the movies from the 1970s, 1980s to kind of what it kind of looks like now. So transportation, Lincoln Town Car. Now a lot of the stockbrokers are just kind of using Uber to get to there. So the restaurant, they might have gone to some swanky place like the 21 Club. Now they're going to Subway, or maybe just like a sandwich shop. After hours. Once again, kind of going to a really nice place to get a drink afterwards. Now is going to Dave and Buster's, having a couple beers, hanging out, playing games. Drink. You got Johnny Walker Blue, which is a really good Scotch. $200 a bottle. Now more people are just kind of going towards Bud Light, which is $5. American Express Black Card, which is a card without a limit. Now we've got a Metro card. And then pastime, which is bottle service at nightclubs, where now we've got trivia night, where more like team building. So I would say the biggest thing whenever you see like a movie like Wall Street or like a Wolf of Wall Street, you know, all these guys, really nice suits. They spend a lot of money. They're doing a lot of drugs, that sort of thing. Whereas now, Wall Street, I'm sure there are still people out there, that are doing those kind of things, but it's a lot more laid back. A lot of these, companies you can, dress business casual to work every day, and you're. I'm not going to say you're getting a lot more nerds in the industry, but you're just getting, people that aren't as like outgoing with it. Where there's a higher premium put on intelligence rather than personality. It seems like so a lot of the people that are on Wall Street today, especially working for hedge funds, are like mathematicians. Went to like MTI, different places like that, and they're just trying to figure out math equations and algorithms to help their hedge fund out in the long run. Whereas in the past it was a lot of guessing game. You didn't have as many tools and ratios at your hand. So, program trading. So this is giving instructions to computers to automatically sell if the price of a stock dips to a certain point to avoid potential losses. So analysts believe program trading caused the turmoil in 1987. And then the exchanges created mechanisms called curbs and circuit breakers to restrict program trading. So program trading is a very big thing today, just with so much technology. We have artificial intelligence creating algorithms that kind of help with looking at stocks. If certain ratios get below a certain point, these computers are instructed to sell, or if certain stocks getting below a certain point, they might buy them just because they might see some value in it that somebody else might not see. So huge swings in the market cause a lot of anguish among Wall Street workers and people in general. What have we learned from market bubbles like those in technology and real estate? So, we talked about this just a couple of minutes ago, with these kind of bubbles that do take place. Just overall, they're going to bounce back. It might not be something that happens overnight, but, in the long term, they will bounce back. I would also advise, anything that's kind of, very trendy right now, I would probably avoid investing in. So, a lot of these like tech companies right now, such as like Facebook, Snapchat, like social media companies, these are all like, hot stocks, to buy into right now. But we've never seen social media before, so we don't know how these stocks are going to do in the long run. If I had a choice whether to invest into Facebook or something like a General Electric or a Caterpillar, I'm going to go with General Electric or Caterpillar just because they've been around for years, and I know exactly what they're going to do for the most part. They might have a down year here and there, but they're a lot more predictable than a lot of these tech companies that are a little more volatile. So talking about the financial crisis, in 2008, so, Wall Street, so they issued, exotic securities, paid excessive compensation based on bonuses. Investment banks got the SEC to relax capital requirements. Main Street Americans lived beyond their means. Lenders gave favorable loans to home builders. Greedy homeowners took out equity loans, and the teaser mortgage rates let people live large. And then in Washington, you've got the Gramm-Leach Billy Act allowed commercial investment banks to partner. Housing interest rates were kept low, and Community Reinvestment Act forced lending to people with bad credit. So overall, it was just kind of the perfect storm between Wall Street, kind of getting bigger. Regular consumers, they were going out, getting big time mortgages, even if they didn't have the funds to pay those off. That was kind of put on the banks as to why weren't you checking the debt to income ratios. And in Washington, they were relaxing a lot of the, their acts and their laws that were put into place. So, after the financial crisis in 2008, we saw a lot more of those acts go into place. Now we're starting to relax them again. So, like I've talked about in the past, it's just kind of a roller coaster, and it just depends on where you're going to fall on it. So key Dodd-Frank provisions. So this gave the government power to seize and shutter large financial institutions on the verge of collapse. This put derivatives and complicated financial deals, including those that packaged the subprime mortgages, under strict government oversight. Required hedge funds to register with the SEC to provide information about trades and portfolio holdings, and then created the Consumer Financial Protection Bureau to watch over the interest of American consumers by reviewing and enforcing federal financial laws. So there's been a lot of talk here recently about rolling back the Dodd-Frank Act. For the most part, you will have Republicans. They generally believe in more of a free economy. Not a whole lot of laws put into place to kind of curb how much an organization can make. Whereas Democrats will typically want a few more laws put into place to make sure that we don't get into tough spots. They want more regulation. So between the two, they balance out each other really well. But it just kind of depends on who has the power in the House of Representatives and the Senate at the time to see which way the United States is going to swing on a certain issue. So that's all I've got for Chapter 19. We will see you next time in Chapter 18.